Well, I think this question sort of answers itself. I mean, obviously, bull markets are much easier to make money in. But I think the thing that you're getting at is, well, what if you had an active view on the markets, and what if you were bearish going into a bear market? Is that an easy way to make money? And the answer is no. And the reason is because bull markets experience pretty low volatility to the upside. You hear markets tend to climb a wall of worry, and they don't do so in sort of these euphoric ways. It's not, in bull markets, it's not stocks rising 3% day after day. It tends to be a slow grind higher, obviously with bouts of volatility sprinkled in, but the characteristic of bull markets is pretty much a low grind higher. Bear markets are the exact opposite. You have stocks falling 15%, bouncing 20%, rolling over again, bouncing again, and this sort of plays itself out over and over. So the point is that even if you wanted to be a hero and you wanted to make money in a bear market, and even if you quote unquote saw it coming, whether it's valuations or internals or whatever you're looking at to analyze the stock market, even if you had a suspicion that stocks were entering a bear market, to have the conviction to stay short or to cover into down markets and then re-engage when they bounce, it's wishful thinking. It's extremely difficult. It's something that I don't know anybody that's made a career out of, not shorting based on fundamentals, but shorting based on either intuition or internals or anything. Like, it is a really difficult thing to do. So for people that are bearish, I would just say to be careful what you wish for. How do you manage risk and capture outperformance, and what's my advice for that? My advice is that you be realistic. If you think that there's going to be a strategy or a product or a person that can protect you on the downside and then give you outperformance on the upside, that's the holy grail. That's what everybody's searching for. It doesn't exist. So what I would say is just, again, to set realistic expectations, have a plan in place, not necessarily a full-blown financial plan. I mean, although I advocate for that, obviously, but just some sort of game plan. What type of investor are you? What are your goals? Why are you investing in the first place? Why are you stomaching volatility? And it has to be tied to some purpose. Otherwise, you're just going to be flailing in the wind. So, but again, the idea that you can do better than stocks when they're going down, or avoid the downturn, and then do better, whether you're leveraging or whatever, I mean, that is highly unrealistic. So I am not necessarily too forward-thinking with this sort of stuff. I'm more reactive, I guess. But I would say that I know that there's a lot of talk about like direct indexing, and maybe it's ETFs that are the next place to be disrupted. I think that there's still a lot of that technology can do to make the advisor's life easier, from trading and billing and onboarding clients. So I am definitely excited to see what is rolled out in the future. So I am very excited about the Wealth Stack Conference. Some of the things that advisors are able to do today, building a portfolio for single-digit to low double-digit basis points, something that obviously wasn't possible in previous decades, all from the birth of technology, billing, trading, block trading, all of this is driven by technology. Client communication through CRMs. Again, all of this is being done by technology. So what would have taken a huge team of people previously is now able to be done with a few people and a whole lot of software. So I am very excited to see what is next in terms of software coming to advisors' lives, how it's going to help us on the portfolio side, on the onboarding side, and all that stuff. So I am very excited to see what's next.